Good afternoon, everyone. It's 12 o'clock here on Wednesday, the 27th of May, and this is our weekly update, a day late this week simply because of the logistics around updating slides associated with Memorial Day holiday on Monday. So this is Joe Gordon, and this is we were just debating prior as to how many we've done. I think this is the 5th or 6th, could be the 7th we've done in a row. They start to run together after a while. So just to cover the disclosures, housekeeping, basically everything in here is not advice. It is not tax advice. It's not investment advice. This is a compliance slide we have to show. And essentially, it's just updating information for general use. So if you can sign up a reminder on our website for these, we're planning to continue to do these weekly because things are getting very fluid in the stock market. There has been a huge recovery, but there's also a big debate about the disconnect with Main Street versus Wall Street. So you can sign up simply there on WealthQB. So let's get in as we normally start. These a few slides, not too many, about the coronavirus cases. You can see here there's over 1.67 million, 23,000 cases per day. That is down from nearly 30,000. You can see the graph over here to the right. There's a little bit downward sloping trend through last week as of May 21st, which was Thursday. The U.S. now has more cases than all the following countries. You see there Spain, Russia, UK, Brazil, Italy, and France combined. And you know, that some say that's because we're doing more testing. But other stats we won't have on this today. But when I look at the top 10 countries, ex-China, and the number of cases per million people, we really fall down to number 9 out of 10. And if you take out the number of cases per million in the U.S. and X out New York City, we actually have the lowest number of cases per million. Anyway, you can see here the decrease overall. The tan states show a little bit increasing, and the change in new cases, the light green and decreasing, dark green very decreasing, and then right in the middle, pretty much steady, the kind of the grayish tint, which is where North Carolina, South Carolina falls, Tennessee, a little bit of an increase. The expectation was with South Carolina, Georgia, Florida, and Tennessee all reopening in full, that you would see a spike short term, and that's really not played out yet. So moving on, many states are lifting restrictions. A lot of you know this just on the call from North Carolina, partial lifting last week, and then even more so, I think, in a couple weeks. And you can see here in the graph that basically there's only a couple states, dark blue, that still have comprehensive restrictions on business and travel: Maine, New Mexico, I believe Maryland, and Delaware. And then you can see basically the orange colored ones obviously are states that lifted many restrictions, the entire Southeast, as we said, but not, there's still some restrictions in North Carolina, as we all, and then basically you see the light blue, some restrictions. And again, that's generally driven by governors, and there has been a political tilt to this. More Republican governors have opened, more Democratic have stayed behind and not. And the Wall Street Journal even had an op-ed yesterday called "The Blue States Governors Are Feeling the Blues." So if you want to go do a search and read that, it's interesting. Anyway, nobody still knows if we're going to have a hot spike, hot zones or whatever, so we'll just have to see. So now let's go and look at the aid packages. You know, the first big one, CARES Act, passed on March 27. You can see there all the different loans: $350 billion for small business, that was under PPP, $600 a week federal unemployment, added to whatever you qualified for state unemployment. And obviously, I saw a change today. Governor Cooper in North Carolina actually replaced who's running that department, reassigned them, is actually what the words they used. Because North Carolina has ranked 50th out of 50 states in timeliness in processing unemployment claims. There's some real horror stories out there of how long people had to wait on the phone to get someone to answer their call. Talk about voicemail hell or being in the queue for someone to pick up your call. It's really unacceptable. The stimulus is mostly played out, $1,200 per person as an adult in a family and $500 per child. And then we had the second round of PPP and aid passed April 24th. And basically 310 went for the PPP. And I saw early this morning, there's still $100 billion in that program not applied for. So if you know any companies that haven't applied that are eligible to qualify, you may want to spread the word. And you see $75 billion for hospitals, $25 billion for testing, $60 billion for small business aid. So obviously, when you look to the far right on the graph, you can just see the amount of money being spent, and essentially, Fed has really opened the spigot unlike they ever have. The big concern a lot of people have, especially investment people, is the CARES Act going to create more problems than it solves? And again, who knows? But the spending, if you look at this graph, in 2020, the federal budget deficit is expected to be 2.2 trillion potentially, well over what we take in tax receipts. And essentially, if the federal debt, it will pass 25 trillion. That's kind of a no-brainer. But it's important to note that debt as a percent of GDP is jumping over 100% and basically hadn't reached there since World War II. So low interest rates are a good thing for this. In order to refinance your debt, the Treasury floated 20-year bonds, which they hadn't done in, I think, 20 or 30 years last week, and had a bunch of stuff, a bunch of demand. But basically, at the end of the day, we all know that it seems like taxes are going to have to go up. So what about taxes? If you can see here, and let's just call it $2 trillion deficit over the next decade, but there's never been this kind of money spent except in world wars. We do have fairly low taxes, and I would argue that from the Tax Cut and Jobs Act, we have some of the lowest federal income taxes that middle income earners have probably seen in their adult lives. And what I mean by that is that until your gross income as a couple married filing jointly exceeds about 345 or 350,000, you don't leave the 24% federal bracket, and that's highly unusual from the past. But that sunsets at the end of 2025, so who knows what'll happen. Capital gains are also at historic lows, and you can see that graphed here down as basically low-income earners don't pay any. Those that have middle income do only 15%, and then 20% is the highest. So those everyone is kind of saying are going to change. We have a couple strategies we can talk to you about privately on how to get in front of that. It deals with the Secure Act and the CARES Act, and we're happy to engage you individually. So let's look at the market recap, and this is where it gets a little bit interesting, is unlike the prior week when the S&P was down, I think 2.6%, and the market last week was up 3.2%, market defined as the S&P 500, which brought its loss year to date to only 8.52. Now, who'd have thunk that when we went from peak to trough from February 19th to March 24th down about 32, 33%, that we've clawed back all of that gain. And so the S&P basically has got a positive return year over year of 4.5%. The NASDAQ is even brighter. It's up 3.44 last week and 3.92 year to date, and 22% positive over the last year. However, there seems to be signals, and this being written about in Barron's and the Wall Street Journal, that there is a rotation underway finally from growth to value. And that's probably signs that you'll see financials picking up. I think energy will continue to pick up from its historic lows, but financials were up big yesterday and today. The market opened up big yesterday and stayed there. It opened up big this morning, but it was giving back a lot of its gains as some people were selling winners or selling into strength. The Dow was up 3.29 last week, making its year return negative 14 and change. So basically, if you look at this and summarize it, the market's pricing in a sharp rebound in 2021. most companies in the S&P, I think over 60%, have pulled guidance for the rest of the year. Everybody's throwing 2020 into the toilet as being recovery from a shock, a pandemic. Never happens. First time most of us have ever seen it happen like this in our lives. So some call it the hope rally. And you can look at the graph here. You can see the extent of basically share of S&P 500 stocks above their 50-day moving averages. So it went way, way, way down to none, and then now it's back. And so if there's 80% of the stocks in the S&P are trading above that 50-day average, that's good. You see a lot of breadth of a recovery. But one of the things that concerns us most is the disconnect between Wall Street and Main Street. And this is this 20-year correlation between the S&P 500 index and its forward price earnings ratio. It's generally 0.9%, which means it's basically almost perfectly correlated at 1. Well, that correlation since March 23rd is minus 0.9, total disconnect. So that's why you see folks calling it a hope rally. And Goldman Sachs late last week, early this week, even said that they think the incongruency calls for a market pullback anywhere between 10 and 15%. Many other people call this the retesting of the original lows scenario. So we'll just have to see. Basically, what's interesting is a lot of investors have sought strong balance sheets. And generally, when you see a market recover like this, investors basically are going strong over weak. And if you look at this Goldman Sachs index, you can see the strong index, balance sheet index, is very positive. The pink one, or the weak balance sheet, is basically much, much lower. And it's down nearly 15 versus plus 15. So that's a huge disparity. So we've had this slide in here before without the FANGs or FAMA. I mean, Microsoft being the M, Netflix being the N. S&P's tracking other markets. In the far right, you can see the S&P index in blue over equal weighted index and mirrored over that. So you can see the market cap weighted index done significantly better, which means it's probably limited to a handful of companies. And that's basically in bullet 2, these mega cap tech companies. They're 20%, about 22% of the index. They've gotten bigger and bigger and basically approaching all-time highs. They're trading at close to 30 times earnings and have very, very strong balance sheets, whereas the rest of the market is trading at about 16 times earnings. So when you look at all of this kind of in a summary, what kind of recovery are we having? Are things happening too quickly? And event-driven bear markets is what most people say we're in, because what was the event? The pandemic. They usually last 9 months. The average drawdown is 29%. Well, we've had in 1 month, we had over 30%. So we'll see if that's really it. And you see in this graph here, other kinds of bear markets, structural, the average is 42 months, and that's triggered by imbalances like the financial crisis of 2008. Cyclical bear markets are typically impending recessions, which we could actually, that's one of the possible outcomes here as well. And again, it's just too early to tell what's going to happen, whether we go from event-driven to recovery or event-driven and fall into a recession and cyclical bear market. So this is a graph courtesy of JP Morgan that we get updated every quarter, and actually about weekly, some of these. And you can see here PE ratios right here, the highest were back in the tech bubble before it burst. And then you can see over here the 25-year average, 16.35 times earnings. And you can see where we are. We're about 21 times earnings roughly. And so in the aggregate, the market looks overvalued. However, when you peel back the mega caps, like I said just recently, it's really not the case. It's about 16 times for everybody else in the S&P 500 index when you take out the 5 big mega tech companies. So we'll just see if this guidance is reliable going forward, but we'll certainly be updating it. Now, let's go to Main Street. We have the highest unemployment rate since the Great Depression. I think there's somewhere between 36 and 40 million people. We'll have an unemployment, report tomorrow. It usually comes out Thursday. And the big issue is not U3, which is the headline number, but because it doesn't measure people that are employed, but basically they're employed at a job for less money because they got laid off from their regular job and they just have to find work in order to pay bills. And so that measures U6, and U6 is cleared and closing in on 25%, nearly 10% higher than it was in 2008. Also, it's worth noting that many times in this unemployment data, it doesn't include people who were previously unemployed and are no longer looking for a job. So anyway, here's basically, another slide to say the same thing. The unemployment rate in the market, it doesn't make any sense. Jobless claims are at their highest rate. The Q3 numbers just under 15%. But oddly, the S&P's continued its linear path to recovery, almost if it's not even considering unemployment news. So, a lot of people are talking about this, and we'll just have to see how things play back and how quick things return to normal. There are warning signs, though, and this is one. Obviously, people sitting at home and having a Wi-Fi connection, they're going to spend less than if they can go out and see things and buy them. And so spending fell off 7.5% in the month of March, down the most since 1959. Credit card spending is down 25% year over year. And basically, a lot of people that are worried about keeping their jobs if they haven't lost it already are cutting costs on what they spend. They're being frugal. Retail sales plummeted also, and it's basically the largest decrease since the 90s, 16.4%. Which is huge, and that's really, obviously, if all the retail stores are not seeing customers walk in, then the only way they're going to have sales is people buying online. Many stores shut down completely during this pandemic, Macy's being one of the top ones. But also manufacturing decline is the lowest we've ever had on record as well. And you can see this graph here. Obviously, we're in a new abnormal, you could call it, but on retail spending. So when you look at, we've had this slide last week, where the changes hurt the worst. You can see clothing down 90%, furniture, electronics are in the 60s, sports, restaurants, bars down 50%, gas stations down 43%. Obviously, people were not driving anywhere. Health and personal care down 10%. And then you see non-store retail up 21%, groceries up 13%. So clearly there's some winners in this, but there's also a lot of big losers at ground zero. 10 leading economic indicators. We've had this slide before. We have one coming up. You can see it graphed here. You can see it's off the chart, record lows in history since they've kept this data. And when you see this indicator graph the way we have it, economic recovery index, basically it's at its lowest reading in history. We know that. We've been saying that for weeks. But it has turned positive the past 2 weeks as the economy started opening up. But again, we'll just see how quickly that keeps going up versus a reversal. Goldman Sachs, which, they got a lot of smart people, basically think stocks are going to fall by 20% over the next 3 months. And that basically saying fiscal monetary policy is warded off a crisis, but we're not getting back to normal anyway anytime soon. And I think a lot of people know that, because when you just talk to your friends and you talk about, I saw where 340,000 people went through TSA and airports on Memorial Day. That's up from a low of 85,000 in late March at the lowest. Well, that's over 4 times more. Well, that's great. Well, the averages year over year are down from 2.1, 2.3 million people a day going through airports. So the return to normalcy is going to take time. But when you look at the fallout from this, many mutual funds have underperformed since the market low. People are wanting to chase the rally. There was a data point last week, I believe it was from David Rosenberg, saying that over half of the Americans that got stimulus checks invested it in the market. That's scary. But basically, the whole inflection curve's not going to flatten for some time as more testing comes into play. And it's going to be a while. Corporate taxes could go up. We got China now, saber rattling, and Hong Kong once again. I guess if there's any positive, there's been a 50% drop in buybacks, but why? Because companies are conserving cash. So then you get into timing the market. So obviously, we've had this slide before. JP Morgan updates it at least every quarter, but you can see here the 20-year annualized returns by asset class through the end of 2019. REITs have done the best, then gold, and gold was in a depression prior to 1999. And then you see the S&P 20-year compounded return at 6.1%, and then you see lower vol balanced portfolios 5.6 with a lot less risk, 40/60, even lower volatility. And so you can see, and then the far right in the orange, the average investor 1.9. A lot of this is because people tend to sell at the bottom and they buy at the top when everyone's talking about their stocks going up. But if you stay invested, you've probably done a lot better than the average investor. So we'll see how that plays out this time. Typically, markets do rebound from any kind of global shock, and usually from epidemics, it's very, very quickly. You can see this graph of all the various type plagues, SARS, the avian flu, the swine flu, MERS, 2013, Ebola, 2014, etc. There is a shock initially, but things do recoil and respond. So what are investment things to consider? And again, we're not making any recommendations. You see a couple quotes here from Kramer, and he makes sense. I mean, we're not Kramer apostles by any stretch. I do find it's entertainment. But the point is that you want companies to invest in that have big enough and deep pocket enough they can weather any economic storm. That perfectly makes sense. You also like ones that have a moat around which they don't have a lot of competition. So basically, quality and big are in. And then you look at technology companies that are thriving because of the shutdown, the stay-at-home economy, and that's cloud-based companies, also cyber protection companies. There are a lot of publicly traded stocks there. And then if you look at companies adaptable to this, there's all kinds of businesses that you've heard of that have done extremely well in that. I think 50 million Americans have a Zoom account for free. But also, I think the things that we should be focusing on are companies as pantry plays, consumer goods, grocers. I mean, they've all seen a tremendous increase in their businesses. And then also streaming services have as well. Some of the gaming stocks as well. And then also biotech's been on a roll with people chasing in the race for the vaccine and pharma. But as we speak today, the rotation is they're selling on NASDAQ. It was down 2% about an hour ago today. Whereas financials, which had been crushed all year, was up big yesterday and today. So essentially, that's our comments for today. If any of on the call would like to talk to us individually about that, please feel free to reach out. Otherwise, have a super Wednesday. It's hump day, and it's only day 2 of the work week, which is always a good thing, people think. And we'll talk to you next week. Thank you.